Everybody. Good everybody made it, because I've been told that there's going to be a big military exercise starting about now. Means that all the roads should be fully empty. I actually wonder if that's true. Okay, what is it that we plan to do today? Again, a lot of options. I think we can go towards the more tricky parts. So I'm going to start with a recap of where we ended in the last lecture. And that was, we talked about skew and we talked about term structure. And we also talked about Vega. So I have here a second question set that I would like to go through with everybody during the lecture. Afterwards, if there's any questions on the discussed, we can do a set of additional examples. And otherwise we go into the potential early exercising of options. To give a bit of an idea, up until now, we applied every option that you had to keep the option in your position until expiry, and only then can you decide what to do with it. In reality, most options are what they call American style, which means you can exercise at any point in time. And we're going to discuss, and it's going to be some analytical formulas, when is the right moment to exercise a call or a put. So that's going to be the majority of this lecture. Let's start with the recap of last lecture. So I'm going to start. I have two options out there. Can everybody see? Otherwise I make it bold. So the first one, I have two options. Option A, which has a maturity of 30 days. I get 20 gamma for 350. I have option B, maturity for 60 days. I have 10 gamma for 150. And the question is, given these two options and their Greeks, looking at gamma and theta and looking at the different maturities, can I say something about events I expect within the next 30 or within the next 60 days? So let's ask for a volunteer. Is this person in by any chance? I think the onus is going to fall again on the person whose names I can pronounce. Is this person in? No? I can try it one more time. Is Carl Victor in? Final try. Is this person in? Okay, then during the next break I'm going to make it based on table numbers. So the question is, apparently there is a difference between these options. And when we look at these positions, we look at gamma and theta. Gamma, of course, is what allows me to benefit from movement. So if there is a certain degree of movement, if I have gamma, I will earn money on that movement. But the flip side of it, every day that passes by, my long option would decay in value. So gamma represents the revenue side of an option, theta represents the cost side of holding an option, so it's all about the relationship. So if I would get 20 gamma for 350, that actually is more expensive than getting 10 gamma for 150. Because if I would sell option A one time, buy option B 2 times, I would be gamma neutral, because I own 20 gamma from the two options B. I'm short 20 gamma from option A, so I'm gamma flat. But in option A, if I'm short gamma, I receive $3.50 a day. And owning the two options B, I only pay $3 a day. So in total, I now receive 50 cents in time decay. But of course, the maturity is not the same. So if we in PowerPoint make something of a timeline, bear with me. Yeah. So what we have, again, after 30 days, after 60 days, between now and 30 days, I'm short 20 gamma from option A, long 20 gamma from being twice long option B, and in theta I receive a half. But after expiry, you notice that I'm long 20 gamma, for which I pay 3. So if the movement, if there would be no difference in movement between the first 30 days and the first 60 days, then of course this could be a beneficial position. But what could happen is that overall I'm paying a higher volatility, or the price of volatility for the first 30 days is higher. How do we see that? If you look at the gamma theta, for option A, which represents 30 days, I get 20 gamma for 350. And option B, which represents until day 60, I get 10 gamma for 150. So this one has a lower gamma theta. So the holding movement, holding volatility for that first set of 30 days, I'm actually paying a higher price. Now what would be if actually all the movement is contained in these first 30 days? Suppose the following would happen. So in these first 30 days, this is where all the movement occurs. And the next 30 days, nothing happens. Then the first 30 days, when all the movement occurs, I don't have gamma. So yes, I receive a bit of theta, but that second set of 30 days, I do need to have enough movement every day to make up for those $3 in theta. So if there's no movement whatsoever in that second set of 30 days, then this might not be the best position. So it looks like easy money, it looks to get free money, because those first 30 days I'm gamma flat to receive money, but if the movement in that second set of 30 days is so disappointing, it might be that I don't make any revenue for my gamma, and I do pay $3 in theta every day. So apparently, either there is free money, or the market expects that the movement in these first 30 days is actually higher than the movement in that second set of 30 days. That would be an explanation. I'm prepared to pay a high volatility for 30 days that include 1 day of an event. That's worth more to me than paying for 60 days, out of which 1 day includes that event. So in this example, this only makes sense. Let's see. This only makes sense. The first 30 days will have a higher implied volatility, a lower gamma theta. The first 30 days will have a higher implied volatility than the first 60 days. So that can only be that that second set of 30 days has an even lower volatility. So which of the explanation could make sense? If there would be earnings between 30 and 60 days, then it would be that second leg of 30 days that would be the most interesting, where the movement's expected. Then actually, option A should be cheaper than option B. At this moment, it's the other way around. Those first 30 days is where the action is. So those are the more expensive month to own an option in. So answer B is correct. The earnings must take place between 30 days and now. So I think the next question is a calculation with regards to earnings. Oh, the first one is just a simple, you in a way translate the last question into volatility terms. Because what did we know? The gamma theta of option A was less favorable. 1 gamma tends to be more expensive. That means that the implied volatility for option A is higher. So now I say the same thing, but now I'm actually putting it in volatility terms. The first 30 days are volatility 32. The first 60 days are volatility 24. So that makes the question, what is the movement we expect that second set of 30 days? And otherwise, let's do one more time that spreadsheet. So, because I think that's a bit more intuitive than just the formula. So what have we got? We got 30 days at volatility 32. I got 60 days at volatility 24. In words, what it actually says is, I expect 2% movement every day for the next 30 days. And 60 days at vol 24 actually means I expect 1.5% movement every day for the next 60 days. So you can already see there is an expectation in here. I know for the first 30 days the movement. I know for the first 60 days the movement. So what happens in these 30 days after? So what we can do, if we just copy this guy. The first part is what's the daily move? And for this, the best way would be to say the stock trades at 100, I have 1 gamma. Because then I can start filling in $100 stock, volatility 32, divided by 16 multiplied by the share price, is $2 movement a day. And for volatility 24, 1.5 movement a day. That's also what I said here. So if that's the movement, the revenue per day is 1/2 times gamma times the movement squared. So it's a 2 revenue for the first 30 days and $1.13 revenue for the first 60 days. So then, if we look at the total movement, or the total revenue, 30 days, each worth 2, makes the movement embedded in that option A worth $60. 60 days, each worth $1.13, makes the movement embedded in these 60 days 67.5. So you now see the movement is expected to be very much in that first set of 30 days. Because out of my total prepared payment for movement, for 60 days I am prepared to pay $67.5 in time value. Out of that I can allocate $60 to that first set of 30 days at volatility 32. So therefore I only have $7.5 to allocate to that second set of 30 days. So what I can now do is the difference is $7.5. So the difference per day divided by So difference per day is a quarter. So I know that half times gamma times move squared is 0.25. So I know that move squared equals this guy divided by a half, because gamma is 1. So that means our daily move is roughly $0.71, which equates to 0.71%. So finally, a movement expected of 0.71% per day results in a volatility of 11.3. So this is how, in a way, communicating vessels, I have a total option of 60 days. For that I'm prepared to pay $67.50 in time value. That corresponds with every day we move 1.5%. I know that the first 30 days, because that also is an option I can look at, actually I expect a movement of 2% a day. So only those first 30 days are worth 60 bucks. So then I can calculate the other days, that second set of 30 days, I expect far less movement. The value of that movement is only a quarter a day. So that boils down to a movement of 0.7% a day, or volatility 11.3. So this is how the whole forward volatility works. So here you see the front month, the first 30 days are vol 32, the next 30 days are vol 24. That means that because of that difference, that second set of 30 days must have a really low volatility. If I would put in the same volatility, both options, 30 days and 60 days, both of them have volatility 32, then logically, that is also what I expect for that second set of 60 days. So in this case, you clearly see I expect the first 30 days, I expect volatility 32, and the second 30 days, I expect volatility 11. So now, if you go back to the earnings argument, I expect much more movement in these first 30 days than in the second 30 days. That must be something like earnings, a court case, something really interesting must take place in that first set of 30 days. Now if I flip the volatility curve around, I say the longer dated volatility is more expensive. So now I pay vol 36 for the coming 60 days, out of which the coming 30 days are volatility 32. So out of a total of 151, or 152 in value, 60 belongs to the front month, so 92 belongs to that second set of 30 days. And there you can see here, now in order to make volatility 32 for 30 days and volatility 36 for 60 days, if I put them next to each other, the first 30 days are vol 32 and the second set of 30 days are vol 40. So in this case, the excitement is expected in that second set of 30 days. So how can you see that? It's just like interest rate. If the long-term volatility exceeds the shorter-term volatility, I expect increased movements towards the end. If the longer volatility is lower than the short-term volatility, I expect a decrease of movement towards the end. The movement is geared towards the current. So that is just like with interest rates, what we call the forward volatility structure. And that is a tool that if I have all these different options to compare, I can not only look if the 1 month, 2 month, 3 month, 4 month options have comparable volatility, I can also calculate all these different forward volatilities to have an idea whether there could be a mispricing. So that is about the difference in volatility that earnings affect. So there were two ways, that was a question somebody asked me before class. There's two calculations you can make, and they are actually, one is more comprehensive, more work, more information than the other. So if I go back to this spreadsheet here, then let's say the first 30 days are vol 2032, the second 30 days are vol 23. So we look at it here, 30-day vol 32, 60-day vol 28. Similar calculation as we did makes that I have the first 30 days vol 32 and the second set of 30 days vol 23. The question that we asked afterwards, if I see these volatility differences, can I estimate how large is the movement expected on earnings day? The idea behind that is there's one exciting day coming, that's earnings. Let's give an example. We had really a couple, oh yeah, we had one good one, let's say here. Chipotle Mexican Grill. Let's look at the 10-day volatility. So can anybody tell me, can you see earnings day? Maybe I need to bring it up a bit. No, oh shoot. Like this. Now everybody can see, right? So we have the share price, doesn't really move that much, doesn't really move that much, boom, and then it doesn't really move that much again. So this is the thought behind what we're doing. For these US stocks, they tend to not really move. They announce earnings, very big move, and then they tend to not really move again. Do you agree? I can show you another one. Amazon. Where are you? Nee, niet doen. Ja, AMZM, US, equity, GIP 10. Same thing. Really not that much movement, boink, really not that much movement. This is where it came from, because what am I now saying? Okay, if there's earnings, you can expect a really big movement. That's volatility. But the other days, not so much. So if I look at my example, I have earnings somewhere in that first 30 days, because the first 30 days are more expensive than the second set. But now I want to dig in. Actually, if I would make a chart for the first 60 days, it would also look like this. Nothing, 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 earnings, nothing, 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 nothing. So do you agree that those first 60 days I can actually classify as one day where a lot of things happen and 59 days where not that much happens? If you agree with me on that, just like the charts, let's do a bigger one here. Where are you? Same as you're seeing here, maybe do GIP 30. See, still same thing. Nothing happening, boink, nothing happening. So it's not unfair to make this assumption. Because now I know more than just one thing. I know that that second set of 30 days is only low volatility movements. And that first set of 30 days is one really big movement and 29 non-movements. Can you live with that? Because if that's the case, then I can do the same analysis, but now within these 30 days. And that was the next step we did. So now I'm just going to copy this whole thing. Copy, paste. And I'm just going to say, okay, I have 29 days in which I don't move, and not moving is the same as that second set of 30 days in which no exciting things happen. So the second set of 30 days, no real movement, is comparable to the 29 out of the first set of 30 days. So now I know I have 29 days at volatility 23.3, and I have 30 days at volatility 32. And now if I do the exact same calculation, you notice that out of $60 in premium, namely 30 days moving 2%, $30 represents those 29 not so exciting days at which I move a bit over $1 each. So that means there's still $29 left, purely represented by that one earnings day. So then I apply the gamma revenue formula. Half times gamma times move squared is 29.25. So if I say gamma is 1, share price 100, which we always did, it boils down to a 7.6% move, or volatility 122. So this is 29 normal days, and this is earnings day. So this was the second calculation I made. So the first calculation, I look at two expiries, 30 days and 60 days, and by applying this logic I can find out the residual 30 days. Then the second calculation I do, I make one assumption. I say earnings day is special and all 29 or all 59 other days are standard. Then that second expiry, that second set of 30 days, represents all 59 standard days. So that means I have 29 out of these fall in my first month, fall 23. My first month trades at fall 32, and only then can I get the difference. So these are the two calculations we do. One of them relates purely to the forward volatility structure, and if the difference in volatility is caused by earnings, then the second question, the second calculation, can identify the movement of exactly that earnings day. Is that clear? Okay. Then the next type of question, we're going to talk. What is it? I'm not going yet. Yeah. So this is a question. We have a regular position. So I'm long the 95 call. I'm short the 105 put. So I'm long an in the money call, and I'm short an out of the money put. Also short an in the money put, apologies. And I have delta hedged. So let's do this with a volunteer. I'm going to give it one more try. Is Mathieu in? Yeah. So let's start at the beginning. So I own the 95 calls. That's an in the money call. Do you have a rough idea how many shares I need to sell to hedge that? Okay, let's start. So we know 3 deltas are easy. A deep, deep, deep in the money call is just like stock. So it has delta 100. A very, very out of the money call doesn't do anything, so delta 0. And an exact at the money call, it's a 50-50 chance whether it will end in the money, so it has delta 50. So this guy is just a bit in the money. So where does his delta lie about? Exactly, say above 50. So let's say it's delta 55. Then we go for the short put. So an at the money put would have delta minus 50. What would be the delta of the 105 put? Exactly, but a bit higher, right? So let's say it's delta minus 55. So if I have this portfolio and I hedge, I'm going to sell 55 shares on the call that I own, and I'm going to sell 55 shares on the put I'm short. So now I have my following position. Yeah. So long call 95, delta 55, short put 105, delta minus 55, so my delta is long 110, so my hedge is sell 110 shares. And now I lower my volatility. And my question is, what happens to my deltas?
How do I lower volatility?
Well, so
By selling the...
no, so in general, I have an option position and we look at pricing options based on implied volatility. So what do? How do I make my options calculations? Let's see if I have that slide. Bear with me. It should be lecture 6, 7, yeah? 5, 6. This guy here. So this is how we look at option prices. I have a model, remember the binomial tree? That if I input volatility, share price, strike price, maturity, interest dividend, it calculates the value of my option. But now I'm going to do it differently. I'm going to look at the market. In this case, the market is on average 6.18. So now I'm going to go back into my system and calculate what volatility do I need to type in, given the share price, the interest, the dividend, the maturity and the strike. The outcome of my calculation is 6.18. That is implied volatility. After I have retrieved implied volatility, I'm going to run it again through my binomial tree, because then I can calculate its characteristics. Delta, vega, gamma, etc. So the action of lowering volatility actually means that I see the prices in the market drop for both the call and the put. So in order to make my formula fit, I need to lower that volatility, because the price of movement has just declined a bit. So if I lower my volatility and I'm recalculating my delta, my gamma, my vega, they might have different numbers. So that's what this question boils about. I see that the market volatilities drop. So therefore, my previously hedged position might have changed characteristics. So it boils down, if I have a lower volatility, what happens to the delta of in-the-money options? Yeah, exactly, it goes towards 100. Because if I lower volatility, there will be less movement expected until expiry, so less things can happen. So for in-the-money options, it becomes a bit more likely they stay in the money. So that means their delta gets towards 100. So on my position, if I lower volatility, would I now end up long delta or short delta on this one? Yeah, because what happens? The delta of the 95 call that's in the money goes to 60, and the put in the money goes to minus 60, so my delta long is now 120. I sold 110 shares as a hedge, so I still end up 10 shares long. So this is the idea. And why is this relevant? If I'm managing a position and I see parameters change, volatility change, I need to make changes, all my portfolio characteristics will be impacted. My vega, my gamma, my delta. So you need to know what's the cause effect. Okay, this one. So we trade at 100 in the share price. I own twice a $5 out of the money put, and I sold once a $5 in the money put. So now I would like to know, what do my vega and my gamma look like? No, wrong one. Is Jonas in? Yeah. So how would you go about? Yeah? If I option, the movement's always in my favor. So long options is always long gamma. Okay. Yeah, so the question is, I have a $5 downside option, so $5 out of the money put. I have a $5 upside option, $5 in the money put. Would they have about equal gamma? Exactly, so if you have 1-on-1, would then the gamma be equal? So exactly the answer to this question, okay, but I have two symmetric options. One of them is $5 lower, one of them is $5. So relatively the same gamma and vega. So if I now own two of that option and I'm only short one, indeed I end up that I still have gamma long and still have vega long. So the idea is a $5 out of the money call or a $5 out of the money put, in this case the 105 strike or the 95 strike, have roughly similar Greeks. Because if you look at the chart, this is what it looks like. They have these bell-shaped, sorry for the ugly one, the curve is always maximized where the strike equals the share price. So here, I have an option where the share price exceeds the strike by $5. And here I have an option where the share price is smaller than the strike by $5. So the idea, as soon as you go away from at the money, those curves are symmetrical. So $5 lower, you see the same decay in my chart as you see $5 higher. The chart is a bit ugly, but I hope the idea makes sense. So in that case, if I would have long one time the 95 put, short one time the 105 put, I would be about vega neutral and be about gamma neutral. But given that I own two of these guys and I'm short one of these, overall I'm long gamma, long vega. Okay, in this question I'm first gonna split into another one. Okay, let's... Because what we can calculate, if I would have a position that is as follows. I'm long 1000 gamma and volatility is 32. Let's say the share price is 50 and the share price moves $1.50 lower. How much do I earn or lose on a day like this? So how can I calculate? This is a question. I have an option, so I own movement. So the benefit of movement is defined by the actual movement. But I also pay daily time decay. The daily time decay I pay is defined by the expected market movement, by implied volatility. So how would I tackle these? Then I would start at calculate theta. Theta is calculated by using half times gamma times move squared based on implied volatility. So in this case, with a share price of 50, implied volatility 32 indicates I have a 2% movement per day. So therefore, at vol 32, the movement is 1. So it becomes a half times 1,000 times 1 squared is 500. So given that the market expects this stock to move $1 per day, owning 1,000 gamma should carry the cost of $500. So that's my theta. That's the implied volatility, expected movement 2%, so that I calculate. But now today, I actually have a different outcome. Because today, we actually move by 150. So therefore I earn a half times 1,000 times 1.5 squared is actually a half times 2,250 is 1,125. So at the end of the day, how much do I earn? What's my P&L? My P&L on this day is I pay 500 in theta. I can do it up here. Different color. Over here I pay 500 in theta, but I make 1,125 from the movement. So I have a plus of 625. Because down $1.50 is a 3% move. A 3% move is volatility 48. So I own options paying volatility 32. The actual movement that I get equals volatility 48. That is something that causes me a profit. Agreed? So there's usually two components. Now we can add a third component. Let's do one more and then I'll ask for a volunteer. So, share price is 100. Gamma, I'm long 1,000. Volatility is 32. My Vega is 1,500. And what